Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. As we begin the final quarter of the year, financial markets and the economy have defied the expectations of many investors. Rather than falling into recession, the economy has grown steadily, albeit at a slower pace, and inflation rates have fallen toward the Fed's target. The market achieves many all-time highs during bull markets. The reality is that facing risks is unavoidable when it comes to investing and planning for the future. Rather than trying to time the market to avoid these risks, it's far better to hold a well-constructed portfolio that can weather different market environments. First, the market has experienced many new all-time highs this year, including during this past quarter. During bull markets, stock indices have historically reached many new all-time highs, as shown in the accompanying chart. Market fluctuations are an unavoidable part of investing, and a decline will inevitably occur at some point. The market has performed well under both political parties. History shows that the stock market has experienced long-term growth under both major political parties, as seen in the accompanying chart. It is not the case that the market or economy crashes when one political party is in office. Policy shifts often occur gradually, and their timing and impacts are frequently overestimated. Thus, investors should focus on long-term economic and market trends rather than daily poll results. The Fed is expected to cut rates further. Inflation continues to moderate, with the most recent data showing the PCE price index, the Fed's preferred inflation measure, and the labor market shows continued signs of slowing with unemployment at 4.2%. The Fed has typically cut rates during economic and financial crises, such as in 2008 or 2020. These are times when the economy and market are expected to struggle for extended periods. The fixed income landscape is shifting. Fed rate cuts have resulted in lower interest rates across maturities, as well as a disinversion of the yield curve. For the economy, lower rates improve borrowing costs for corporations and individuals, potentially boosting economic expansion and investment prospects. This can be positive for economic growth, which then translates into better earnings and corporate fundamentals. Geopolitical conflicts are worrisome, but do not directly impact markets. Despite geopolitical uncertainties, the stock market has experienced only 5% or worse pullbacks this year, emphasizing the importance of staying invested and focusing on broader market trends rather than reacting to headlines. The bottom line? With the Fed cutting rates, the election on the horizon, and markets near all-time highs, it is more important than ever to stay focused on long-term financial goals rather than short-term events. Thank you for listening. For additional information, please visit MRAadvisory.com.